Welcome to the Deep Dive. We're your shortcut to getting really informed on interesting topics. Today, we are plunging into a pretty fascinating report. It's about a company that seems poised for some serious growth. We're talking chemical and pharmaceutical intermediates here.
That's right. For this deep dive, we're focusing hard on Blue Jet Healthcare, and we're drawing our insights directly from a recent financial analysis report by Motilal Oswal,
Hmm.
specifically looking at their Q1 FY26 results and, their forward estimates. That report just came out July 23rd, 2025.
Okay. So, our mission for you today is to unpack the key data points, really understand the strategy Blue Jet is pursuing, and also grasp the wider market context that's shaping things for them. We'll give you clear takeaways, maybe some surprising facts too, help you see what's truly important. So, let's get started. Right, kicking things off with their recent performance. Blue Jet Healthcare reported revenue of 3.5 billion INR. That's for Q1 FY26, which is genuinely robust, actually. It's showing 2.2 times growth year over year and a 4% bump quarter on quarter. Pretty much right in line with what analysts expected.
Yeah, solid top line. And what's really interesting is what drove that growth. Their pharma intermediaries, PI and API segment, absolute powerhouse. It surged 3.5 times year over year. That's huge. Came in at 2.1 billion INR. The report specifically notes this segment is sustaining really robust momentum. It's clearly a core strength.
And it wasn't just PI and APIs carrying the load, was it?
No, not entirely.
The contrast media intermediates, CSEA, that segment also showed strong expansion, up 51% year over year, hitting 972 million INR. Although on the flip side, their high-intensity sweeteners, or HIS revenue there, was flat, just stayed at 349 million. So a bit of a mixed picture below the surface, but strong overall revenue, definitely.
Right. But despite that impressive top-line growth, we did see some, margin pressure. Their gross margin landed at 48.4%. Now, that's a noticeable contraction from 54.9% in the same quarter last year, and also down from 54.7% just the previous quarter.
Okay.
And similarly, the EBITDA margin also tightened up. It contracted to 34.1% from 41.1% a year ago. That kind of dip, it definitely catches your eye.
It does. So what's the story there? Did management explain that margin squeeze? Is it like a sign of deeper issues or something else going on?
Well, according to management commentary, the dip was primarily down to two things: a shift in their product mix and also reduced inventory levels. And that reduction in inventory meant lower overhead absorption for the quarter.
Okay. So fixed costs spread over fewer units, basically.
Exactly. Things like factory rent, depreciation. It makes each unit seem temporarily more expensive to produce. It's often just a short-term thing when they adjust inventory levels. To put numbers on it, they said over 4.4% of that 6.5% gross margin drop was specifically due to the inventory adjustment. The other 2.1% was the product mix effect, more from PI/API, less from the others category.
Right. So even with strong revenue, these operational tweaks hit the profitability for Q1, and it looks like analysts noticed because following this performance, Motilal Oswal actually cut their earnings estimates down by 6% each for both FY26 and FY27.
Yeah, that's right. The company's actual EBITDA, which was 1.2 billion INR, and their adjusted PAT at 912 million. Both came in below the analysts' initial forecasts. They're expecting more like 1.5 billion and 1.2 billion, respectively.
Okay, so that sets the stage. Looking at that recent performance and those pressures, it really highlights why their strategic roadmap is so important now. They're planning a pretty significant addition, aren't they? A
Yep.
1,000 KL of capacity.
Yes, huge, over the next 2 to 3 years, on a newly acquired piece of land, and they're planning to develop it in 3 phases.
Wow. What's the thinking behind such a massive expansion? What's it for?
It's definitely ambitious and really crucial for their future positioning. It's designed to support a whole range of high-value products, APIs included. They specifically mentioned bempedoic acid API as a key target. So think of it as laying the foundation for the next growth waves.
Makes sense.
And phase one specifically, that will include 4 blocks, 2 for contrast media intermediates, 1 for sweeteners, and 1 MMP block. Critically, they're also developing a backward integrated facility. That's at Unit 3, Mahad.
Backward integration. So making their own key raw materials.
Precisely. It gives them much greater control over quality, over cost, reduces reliance on outside suppliers, builds resilience. It's strategically very important. And the budget for that Unit 3 Mahad project has actually gone up. It's now around 3 billion INR, up from an original estimate of 2.5 billion. They've already spent about 1 billion, and the other 2 billion will be spent by FY27.
Okay, that's a serious long-term investment in their capabilities and in supply chain control. But it's not just about building new factories, is it? they're also putting money into R&D.
Absolutely essential part of the strategy.
What areas are they targeting there? What does that tell us about where they see the future?
They've committed a good chunk of capital, 400 million INR, specifically towards R&D capabilities,
Hmm.
and the focus is on amino acid derivatives and late-stage intermediates.
Okay, complex stuff.
Yeah, exactly. These are often the building blocks for sophisticated, high-value pharma compounds. It's a smart play. Their R&D pipeline looks pretty robust, too. They have 20 opportunities showing high client interest. And about 30% of those, so 6 projects, are already in late phase 3 or actually commercial.
That's a strong conversion rate. Suggests they're working closely with clients.
It does. And it suggests a mature pipeline. Plus, they've also developed around 45 peptide fragments. These are ready for commercialization depending on customer interest.
Peptides. That's a hot area in pharma development, right?
Increasingly so. Things like oncology, metabolic disorders, it positions them right at the cutting edge.
Very forward-looking. Okay, so given these big investments in capacity and R&D, what are the growth expectations for the different segments?
Well, for pharma intermediates and APIs, they expect that robust growth to continue right through FY26. They say they have strong customer demand visibility. Plus, more product launches expected in the second half of the year. Cardiovascular or CVS applications seem to be a key driver. They've got 120 KL capacity dedicated just to CVS intermediates.
Right, and contrast media.
That's also expected to grow, mainly due to a ramp-up in client offtake. And importantly, their new CDMO capacity for PI and SEQ-CMI at Unit 2, Ambernath, is now fully operational, so they're ready.
Okay. What about high-intensity sweeteners? We saw flat performance this quarter. What's the outlook there?
The expectation is for steady volume performance to continue, sustain itself. And a key development here is they've received an inspection report from the US FDA. That's a big milestone for market access, quality assurance.
Definitely.
Plus, their Phase 2 expansion at Unit 2 is fully running, and the Unit 3 construction in Mahad is on track for commissioning in the second half of FY26. So it seems like they're well-positioned to meet demand there, too.
So, pulling all this strategy and market positioning together, what's the bigger picture here for Blue Jet?
Well, if you connect it to the wider industry trends, management sounds really confident about FY26. They point to these big structural tailwinds, particularly the whole de-risking of global supply chains by innovators.
Ah, the China plus one strategy we hear so much about.
Exactly.
Mm.
Global companies wanting to diversify away from relying too heavily on China. They want to mitigate risk, build resilience. And Blue Jet's expertise in these complex APIs, like the bempedoic acid we mentioned, and their push into peptide fragments, it isn't just about general growth. It's about positioning themselves as a high-value, reliable, de-risk alternative, which is precisely what global pharma companies are looking for right now, beyond just basic manufacturing.
So the question is, how well are they actually positioned to capture that global shift? Seems analysts are optimistic.
Very optimistic. The Motilal Oswal report projects strong growth rates. They're forecasting revenue, EBITDA, and PAT compound annual growth rates, PJAWs, of 35%, 38%, and 35% respectively. That's for the period FY25 through FY27. Those are impressive numbers.
They certainly are. Okay, let's shift to the investment perspective then. How do the analysts view Blue Jet Healthcare after crunching all these numbers and looking at the plans? Is it a buy, hold?
Motilal Oswal is sticking with a BUI rating. They've reiterated it. And the target price is set at 1,100 INR, which, compared to the current market price mentioned in the report 817 INR, implies a potential upside of around 35%.
A 35% upside potential. Okay. And what's the valuation based on?
It's based on 35 times their estimated FY27 earnings per share, or EPS.
Right. And how does the current valuation look, and how is it expected to evolve?
Well, the company's price to earnings, or PE ratio, is projected to come down quite significantly, from about 46.3 times estimated FY25 earnings, down to 25.3 times estimated FY27 earnings.
Wow, that's quite a compression.
It is. And similarly, price to book value, PDV, is projected to go from 12.5x down to 6.9x over the same period. It suggests analysts believe the company is going to grow into its valuation pretty aggressively as those earnings come through, making it look much more attractive down the line.
Interesting. And who owns the company? Any insights from the shareholding pattern?
Yeah, this is quite significant. As of June 2025, the promoters hold a very large stake, 86.0%.
86%. That's high.
It is. And for a company undergoing this kind of major expansion, it signals huge confidence from the founders, the core stakeholders. It ensures, strong alignment between management's long-term vision and shareholder interests. FIIs, foreign institutional investors, hold about 2.0%. DIIs, domestic institutions, hold 0.9%. And the public and others hold the remaining 11.1%.
Okay. Finally, let's touch on operational efficiency. Are they making good use of their assets? And what about their current capacity? Can they actually handle the growth they're expecting?
They seem pretty efficient. The report notes an asset turnover of 4x on their net block, which basically means they're generating 4 rupees of revenue for every rupee of fixed assets they own. That's generally considered quite good.
Okay.
Inventory days are currently around 131. But what's really crucial here is the capacity utilization. It's currently reported at 60%.
60%, so plenty of headroom.
Exactly. It indicates substantial room to grow and leverage that anticipated demand increase without needing another massive wave of investment immediately, beyond what's already planned, of course. They seem to have the space, the efficiency, and the strategy lined up to scale significantly.
And there you have it. We've walked through Blue Jet Healthcare's latest numbers, dug into their pretty ambitious growth plans, and looked at why analysts see significant potential here. You should now have a really solid grasp of how a company like this, in a specialized sector, balances those short-term pressures, while executing a long-term strategy, really trying to capitalize on those big global supply chain shifts.
Absolutely. The picture that emerges is one of really quite precise strategic investment for future growth, tapping into major industry trends.
So here's a final thought for you to mull over. Considering Blue Jet's very clear strategy expanding capacity, investing heavily in R&D for complex intermediates APIs, how might this forward-looking investment position them? Not just for the growth we've talked about, but maybe for a larger, even more transformative role in the global pharma supply chain over the next decade. What competitive advantages could they really lock in? And maybe what's the next big innovation area they could pivot towards that would truly cement a unique position? Something to think about until our next deep dive.